We are diving deep today. And, if you listen to financial news, you might think investing is all about this high drama. The dizzying highs, the spectacular falls like Jordan Belfort and Wolf of Wall Street. But true lasting financial mastery is actually much quieter.
Yeah, much quieter. It's more like that ruthless, patient preparation. Think Michael Burry in The Big Short, just waiting, seeing those systemic flaws that, others just refuse to see.
Exactly. And that quiet focus, that's really what we're digging into today. Our mission here is to give you a kind of shortcut, a way to become truly unbreakable in the market. We've basically distilled, 80 plus years of battle-tested wisdom from giants like Buffett, Ray Dalio, and Nassim Taleb, and we're weaving in the latest 2025 strategic insights too.
And we really have to tackle this. I mean, the statistics are just a brutal wake-up call. 80%. 80% of retail investors consistently underperform the market over time. It's staggering.
And it's not about smarts, is it?
No, not at all. It's not about intelligence. It's about repeatedly falling into the same, soul-crushing mistakes. If you're trapped in that cycle, you're stuck in that 3.6% annual return club. When the S&P 500 historically averages closer to, 10%? It's a huge difference.
Huge. So let's start with the fundamental rule. Straight from Warren Buffett, right?
Okay.
The first rule of investing is don't lose money.
Right.
The second rule, never forget the first.
Sounds simple.
Yeah, sounds simple, but avoiding loss. That means identifying and neutralizing the pitfalls that ambush even, smart beginners.
Yeah.
So let's unpack these deadly traps first. Okay, so we're starting with the carnage, the common behaviors that were just totally maximized during the dot-com bust.
Oh, yeah.
And that 2022 crypto winter. These are the traps that really torpedo portfolios most often.
And trap number one, it's pure psychology, the herd mentality. This is where FOMO, that fear of missing out, just completely takes over. You see a stock or maybe some asset that shot up, 50% in 6 months, everyone's talking about it, and you just feel this compulsion to pile in, completely blind.
So what's the actual outcome? What happens when you chase those hot tips?
Well, it leads directly to buying at the absolute peak and then selling in a total panic when the inevitable dip hits. We saw this, institutionally in The Big Short. Wall Street lemmings chasing what they thought were safe, high-yield assets, those subprime mortgages.
Right, until the whole thing just imploded.
Exactly, and the data backs this up. 70% of day traders, the ones trying to follow the herd every single day, they lose money long-term. Chasing yesterday's winners, it almost never works out.
Okay, so that leads into trap 2, which you said is connected.
Directly connected. Emotional trading. This is the real investor kryptonite. It's driven by fear and greed, and it forces that dreaded buy high, sell low cycle.
Okay, but what's the practical antidote? Especially when the market's crashing and, every single headline is screaming disaster. It feels impossible not to react emotionally.
It is incredibly difficult. You have to install a protective layer of discipline. And the wisdom here is timeless. Buffett's advice, right? Be fearful when others are greedy and greedy when others are fearful.
Easier said than done.
Oh, absolutely. It means checking your emotions at the door, acting contrary to the panicked crowd. It's psychologically tough, but financially absolutely necessary.
Got it. Okay, moving on. Trap 3. The over-concentration trap. We see this a lot, don't we? People may be heavily invested in their company's stock or just one sector they feel really strongly about.
Correct. You put all your eggs in one basket, then a single bad earnings call, maybe a lawsuit, a regulatory change, boom, it can toast your entire portfolio. Schwab calls this a hidden killer because it feels like confidence, right? Like you know what you're doing.
Yeah, conviction.
But it's actually extreme risk.
And we've seen that risk play out. Statistically, these undiversified portfolios crash, twice as hard in bear markets?
At least, yeah.
It only takes one massive bad bet, like the one that sinks the whole trading floor in margin call. That film really drives home the danger of placing too much faith in just a few things.
And then there's trap 4, maybe the most common delusion out there. Trying to time the market. Everyone says, I'll buy low and sell high.
The dream, right.
The dream. But studies show even the highly paid professionals, they fail to time the market correctly, something like 80% of the time. Right. And the cost of trying is just enormous.
Why is the cost so enormous? Just being out of the market for a bit.
Because if you miss just the best 10 trading days over a 20-year period, you effectively have your total return.
Have them. Just 10 days.
Yeah. That's how much those crucial, often unpredictable upswings contribute to compounding. That's exactly why Buffett's advice is, our favorite holding period is forever.
Okay, but hold on. If the holding period is forever, How does that square with, say, needing the money? Like when you're nearing retirement or saving for college. Isn't forever maybe too aggressive for someone who just can't stomach decades of volatility?
That's a really crucial point, and it leads us right into trap 5, ignoring the sleep test. Or you could call it risk mismatch. See, Buffett's forever idea, it assumes you've got decades of runway, and you can handle mentally extreme volatility.
Which isn't everyone.
Not at all. Too many beginners try to mimic aggressive young pros. They dive into, say, high beta tech stocks, and then they realize that a sudden 20% dip causes genuine anxiety, sleepless nights, panic. Ray Dalio really emphasized this in Principles, mismatching your bets to your life stage, your personality. It just leads to burnout and, frankly, bad choices under pressure. If the volatility keeps you awake at night, you are, by definition, overinvested in risky assets for you.
Makes sense. Okay, and finally, trap 6. This one's quieter. The slow drain. The silent saboteur fees and taxes. It's easily overlooked, right?
Yeah.
Because the numbers seem small. 1%, 1.5%.
Exactly. That seemingly tiny 1% expense ratio on, say, a mutual fund. It silently compounds over 30 years to eat up over 25% of your potential profit.
A quarter of your gains? Gone.
Gone. You wouldn't pay an advisor 25% of your future wealth up front, right? But high fees effectively do that to you over time.
Wow. Okay, so the takeaway here, Buffett's solution.
It's simple. Opt for low-cost index funds. He says it's his #1 pick for 90% of people.
Right. But, okay, avoiding traps is just defense. That's crucial, but it's not the whole game. Let's flip the script now. How do we actually implement the offense? Build wealth. So we're shifting gears now. Let's talk bulletproof strategies. These are pulled from JP Morgan's Timeless Principles, but also recent 2025 Financial Insights. How do we take that defense we just talked about and actually start building something solid?
Okay, strategy 1. Build a rock-solid plan. And this isn't vague. It means defining your goals. Retirement, buying a house, whatever it is. Then you need to honestly assess your true risk tolerance. Use standardized tools, maybe like a Vanguard quiz, get a real sense of it. Then you put that plan into action. It needs to be concrete.
And a key part of that plan, I saw this mentioned, is regular maintenance, rebalancing yearly. Can you clarify what rebalancing actually means? I saw some phrasing like it helps you stay 20% ahead, which sounds a bit like hype.
Yeah, that phrasing is definitely misleading. Rebalancing doesn't guarantee higher performance. It's not magic. It's a necessary tool for risk management. That's the key.
Okay.
So if your initial plan was, say, 60% stocks, 40% bonds, and stocks have a great year, maybe your allocation drifts to 75% stocks, 25% bonds. Rebalancing just means selling some of those high-performing stocks and buying bonds to get back to your target 60-40.
Ah, so you're locking in some gains and sticking to your original risk level.
Exactly. You're forcing yourself systematically to sell high and buy low, relatively speaking. And crucially, you're maintaining your intended risk profile, not letting success make you take on more risk than you planned.
Got it. Okay, strategy 2, diversify like a master.
Right. The traditional 60-40 stocks bonds split, still foundational, but the modern upgrade really involves global exchange-traded funds, or ETFs.
Okay, for anyone new to the term, what exactly is an ETF and why is it better than just picking individual stocks?
Good question. An ETF, an exchange-traded fund, is basically just a basket. It holds hundreds, sometimes thousands of different assets like stocks or bonds from various companies or countries, but it trades just like a single stock on an exchange. So with one purchase, you get broad diversification instantly. Super simple.
Oh, okay.
And going global, as firms like Invesco suggest, means adding assets beyond just the U.S. market. And these 2025 insights, they suggest adding alternatives too, things like real estate investment trusts, REITs. Doing that can potentially cut your overall portfolio volatility by maybe up to 15%. That really hammers home that Buffett quote, doesn't it? Diversification is protection against ignorance.
Precisely.
It's your safety net when you just don't know which sector or which country is going to tank next year.
Strategy 3 is the key to consistency, really mastering the long game. Go low cost, long haul. We already established that low cost index funds beat, 90% of active managers over time?
Right.
So the technique Schwab often recommends for implementing this discipline is dollar cost averaging, DCA.
Okay, explain DCA. It means investing a fixed amount, say $500, same day every month, no matter what the market's doing, up or down.
Exactly, regardless of the price. If the price is high that month, your $500 buys fewer shares. If the price drops, your $500 automatically buys more shares. Over time, this natural rhythm just smooths out your purchase price. It totally mitigates the risk and the stress of trying to guess the market bottom.
So it turns that timing prep into just a structured automatic habit.
Perfect way to put it. Takes the emotion right out. Okay. And strategy 4. This one feels foundational, almost like step 0. Emergency buffer first.
Absolutely non-negotiable. Crucial. You need 3 to 6 months of essential living expenses in cash, liquid, easily accessible, like a savings account. And that needs to be there before you invest a single dollar in the market. Seriously.
Why is that sequence so critical?
Because if you don't have that cash reserve, the moment a life crisis hits a big medical bill, losing your job, what happens?
You have to sell investments.
You're forced to sell your long-term investments, and likely at the worst possible time, probably when the market is already down. Don't let a short-term emergency absolutely wreck your long-term financial plan. Buffer first. Always. Okay, let's try and connect these strategies now to some of the big thinkers, get some more advanced context. We need to look at Buffett's perspective, sure, but also alongside the really profound insights of the Black Swan theorist, Nassim Nicholas Taleb.
Okay.
So, Buffett's perspective. It's deeply rooted in knowing your circle of competence. As he says, risk comes from not knowing what you're doing.
Simple enough.
Right. This is why he invests in those quote-unquote boring businesses he fundamentally understands, like Coca-Cola. His massive bet on Apple, which people questioned initially, it succeeded because he understood the long-term competitive moat, that ecosystem. He had the conviction to hold firm, even through significant dips, because he understood it.
And then you have Taleb's Black Swan edge. His whole philosophy, especially in Fooled by Randomness, it's about building systems that can handle or maybe even benefit from those blind spots, those extreme, unpredictable events. Like a global pandemic, for instance.
Exactly. It's not just about surviving those events. His core concept is achieving anti-fragility.
Anti-fragility. What does that mean in practice for an investor?
Well, stacking cash is part of it, sure, having reserves, but the deeper insight is avoiding fragility. Anti-fragile systems aren't just robust, they don't just resist shock, they actually get stronger when stressed or exposed to volatility. So for an investor, this means structuring your portfolio and your mindset so that if a rare major event happens, you have the liquidity, yes, but also the emotional stability to pivot, to maybe even capitalize on the market dislocations that follow.
Instead of being forced into selling at the bottom.
Exactly. Instead of being the one forced into painful sales, you're potentially positioned to benefit from the chaos because your system was built for it.
Okay, to make these high-level lessons really stick, let's revisit those movie parallels, but maybe with a slightly deeper technical lens. The Big Short. It showed us why diversification and understanding what you own is so vital. Those complex assets, they bet against the CDOs. They weren't just safe AAA-rated bonds, were they?
Not even close.
Right.
They were collateralized debt obligations. These incredibly complex derivatives built on mortgages, sliced and diced until they look safe on paper, but in reality, ticking time bombs. The clear lesson is, if you don't truly understand the asset, you shouldn't own it, period.
In Wall Street, the 1987 original, that shows the danger of pure ego combined with leverage. Gordon Gekko's greed is good mantra. It becomes disruptive pretty fast when you let that confidence, that ego, just eliminate your basic risk management, your diversification.
Absolutely. Hubris is a portfolio killer. Okay, let's talk advanced tactics now. For listeners ready to really level up their mindset, their approach, maybe the single biggest behavioral upgrade you can make. Shift your focus. Look at your portfolio quarterly. Do a proper review. Stop checking it daily or multiple times a day.
That's a hard habit to break for some people.
It is. But research, like from Manulife, confirms it. Combating investment anxiety requires replacing that constant emotional reaction to headlines with periodic data-driven review.
Makes sense. We also saw a recommendation to adopt the mistake autopsy. What's that?
It's basically an annual, honest, critical review of what went wrong in your portfolio or your decision-making over the past year, not just celebrating the wins. You have to follow Buffett's essential rule here. Change your mind when the facts change. Don't cling to bad investments out of stubbornness or ego or just because you don't want to admit you were wrong. Learn from it.
That requires humility.
A lot of it. And finally, never forget the power of time. This is the procrastination killer. Study after study shows that delaying your investments start by just 10 years. It can effectively halve your potential nest egg, even assuming a modest 7% average return.
Have it just by waiting a decade.
It's the magic of compounding working against you when you delay. Time isn't just an asset. For a long-term investor, it is your ultimate superpower, and it's finite. You can't get it back. #tag outro.
Yeah. Okay, so we've covered the 6 deadliest traps and hopefully some ironclad strategies to counter them. The key takeaway seems to be that investing mastery, it isn't about perfection, right? It's not about finding the next hot tip before anyone else. It's about discipline, consistency, patiently stacking those small wins over time, like Burry's patient bet versus that constant frenetic chase of hype we see everywhere.
Exactly. So here's the final boss question, if you will. Something we want you, the listener, to reflect on right now. Out of all those key mistakes, we discuss the traps of emotional trading, maybe concentration, ignoring fees, trying to time the market. Which one really hits home hardest for you? Which one feels most familiar? And why? Because dodging that one specific weakness, identifying it and installing a rule or a system to prevent it, that's the absolute first, most powerful step toward building an unbreakable financial structure for yourself.
Yeah, finding your personal kryptonite.
Precisely.
Okay, and here's a provocative thought maybe to carry with you after this deep dive. The most essential tool for your long-term success. It isn't some expensive stock picking service. It's probably not even a sophisticated AI analysis tool.
Although AI can be powerful for rapidly verifying claims against, say, SEC filings, that's a useful check.
True, but the most essential tool. It's the foundational act of just beginning, compounded by consistent discipline over years and decades. So what small discipline move can you commit to today? Maybe it's setting up that recurring $50 a week automatic investment into a low-cost S&P ETF, just starting.
That first step.
Time is your superpower. Use it. Revisit this guide if you need to, refine your plan, and then just repeat that discipline again and again.